Good evening everyone and welcome to this seminar, half-day seminar on export incentives available under GST law, customs duty and foreign trade policy. We also have this session continued on the e-way bill, detention of the vehicles under the GST law. So today we have two speakers to address us on this matter. One is CA.Pradeep Reddy and the other one is CA.Nithin Hebbar. I request our chairman Pramod Reddy to escort both the speakers to the dais and greet them with a floral bouquet. Pradeep and Nithin, welcome to both of you. Thanks for being here. Please take your seats. I request Chairman to give his welcome address.
Good evening, my dear members. I was very delighted to see the registration number. We had already crossed 200 plus we were counting, and people were calling me saying that why don't we have additional people accommodated. So we were trying to do that. In the meanwhile, most of the members said that we are on our way, so let's start. So I thought let's not take much of your time. Finish at least the formal inauguration and leave it to the speakers. Because today's topic is actually a very important discussion both for the exporters and professionals like us. Especially when we have this export incentives under GST, custom duty law, foreign trade policy, along with practical issues in e-way bill and vehicle detention, which we have been seeing of these late. It's a topic of very interesting fact. Then I also came across our own circular of ICI, which had extended the CP. Then my benefit of doubt got clarified is, of course, that today's legislation is because of the CP than most of the topic. But nevertheless, as always, Bangalore branch looks at contemporary topics, see what is relevant in the profession, and designs the program on that. So as part of that initiative, we were proud enough, but of course, let's at least continue to do so. And also, I'm very thankful to Pradeep Reddy and Nithin Hebbar, who bring a tremendous knowledge of wealth and practical insights on this subject, and they will surely immensely add value to our knowledge today on this topic. And also, I would like to, on this welcome address, I would like to congratulate all the newly elected members of the Bangalore branch. Of course, the sitting members have continued to come out. Where our Vice Chairman Manjunath Allur, our Secretary Kavita Parmesh, our Treasurer Tupar, Managing Committee CP Jain, who is also here, and Shripad, Sikasa Chairman, and the new Managing Committee members Sri Raksha, Nischal, and Raghendra Hegde. I think the new young team will continue to make the dynamism, keep up the dynamism of the Bangalore branch, and I wish them all the success. Of course, I'm there till the next 20 days, will still see my face before I take over the new role. With this, I would like to welcome you all for this program. Make sure you ask your questions, of course, what is relevant to us for billing, and of course, ensure that your personal questions are also heard on these topics so that we can solve our doubts and include, make it very participative. With this, welcome you all. Over to Kavita for the speaker introduction.
Thank you, Chairman, for that address. Quick introduction of the speakers for the day. CA.Pradeep Reddy, he is a chartered accountant since May 2014, and he has expertise in the indirect taxes encompassing GST, customs duty, foreign trade policies, service tax and state excise laws. He was part of the Big Four and before starting his practice, and since his practice he has advised Indian and multinational clients from various industries ranging from electronics, gaming, e-learning and so on. His expertise extends beyond compliance, and he is skilled at tax litigation, transaction structuring and optimizing indirect tax implications. He is part of he has written a couple of articles for the monthly newsletter of Bangalore branch, and is also part of the KSCA, Karnataka State Chartered Accountants Association Indirect Tax Committee. He is also part of Bangalore chapter of Young Indians, the social volunteering organizations, and also CIA, where he is serving on its economic affairs panel. It's a pleasure to have Pradeep among us, and Pradeep, thank you for being here. Welcome to you again. The next speaker is Nithin Hebbar. He is practicing chartered accountant and is pursued his since 2014. He is qualified in the year 2014. He started his own practice in 2021, and prior to that he was consulting with Big Fours. He heading their indirect tax practice. He is also assisted. He is deputed for assisting companies in GCCs in implementing VAT during 2018 and carry forward the experience earned during GST implementation in India. He represents trade before the departmental bodies and judicial forum such as SESTAT. He has also addressed various trade bodies on various topics of indirect taxes. He is pursuing his LLB currently. So it's an honor to have Nithin among us. Thank you, Nithin, for being here. Welcome to you. Pradeep will address us first, and post that we'll have a break at 6:30, and then Nithin will take over. I'll hand over the dais to Pradeep. Over to you.
Hi, good evening everyone. Thank you ICAI Chairman and Vice Chairman and Managing Committee for giving me this opportunity. In fact, this is my second time I'm addressing the members. The first time I spoke in Chennai in November month. So hopefully I'll be able to add value to you. The goal of this next 1.5 hours is that you will take away at least one idea which you can implement for your client with respect to the export incentives. So yeah, I look forward to this. So what is in it for the members in this meeting, in this session? So broadly, so as far as incentives under indirect tax is concerned, so predominantly the incentives under indirect tax will help increase the bottom line. So at the end of the day, indirect tax is a transaction tax. So as long as we are able to reduce it or recoup the indirect taxes, that will be accretive to the bottom line. So therefore, that way managing indirect taxes and the incentives, if any, under the indirect taxes will make a significant difference. So in this session, we will be talking about broadly three things. One is refund schemes, wherein we get refund in cash of taxes which we have already paid. The second bucket is exemption scheme, wherein we can avail exemption upfront without paying tax upfront. So under exemption, we'll not pay anything, and we can import or procure without paying customs duty. So third is deemed exports. So under deemed exports, this is a scheme wherein we get incentives even though they are supplied to customers who are located in India. So as against the popular notion, you will get incentives only if you are exporting. There is a special concept called deemed exports, both under GST law and foreign trade policy, which allows us to seek incentives. This is called deemed exports. Now, straight away we'll jump into the refund. So again, under refunds, there are three things, which is first one is RODTEP scheme, which is the name itself is too big. Remission of duties and taxes on export product scheme. Basically, this scheme gives a refund of taxes which are not getting covered under any other scheme. It's like a residuary scheme. Okay. The next one under refund scheme is duty drawback, In simple terms, this is refund of customs duty on the raw materials or finished goods which we use in our business. The third refund scheme is the popular one which you might have been seeing everywhere, which is GST refund. Again, there are two variants in it. One is refund of input tax credit and refund of GST on exports. So then under exemption scheme, there are two things again. One is advance authorization, which is nothing but we can import raw material without paying customs duty. And same concept, if it is for capital goods, it is called EPCG, export promotion capital goods. And the last one is deemed exports, which we briefly touched upon. And the overall, during this 1.5 hours, the idea is to give a brief about each of these schemes. Each of these scheme can run itself 1.5 hour each. So therefore, the idea is to cover only the brief points so that you can consider this for your clients or in your day-to-day professional work. The first one is RODTP, which is basically this scheme allows refund of taxes which were not allowed as refund under any other scheme. So if you take for example, so we might be paying say VAT on petroleum or electricity duty, stamp duty. So all these things are costs. We don't get any credit for these taxes which might be levied by state or the central governments respectively. However, we don't get any credit. It's a hit to the P&L. So if we were to export the products, any products, by using these as input, if there is an export company who is an exporter who is manufacturing goods, he definitely needs electricity. He has to pay electricity duty for which there is no credit. Similarly, he has to run his factory. Invariably, he will have to use petroleum products on which he has to pay VAT, again for which there is no credit. So this scheme is meant to refund those taxes for which there is no credit as on today. So therefore the definition, remission of duties and taxes on export products. Okay, and the brief background to this is that this scheme is introduced in 2021. However, the major event has happened somewhere in 2019. So before this, there was a scheme called MEIS, Merchandise Exports from India scheme. So wherein we used to get scripts, which are nothing but certificates based on the value of export of goods we make. However, that is litigated by the US in the WTO, World Trade Organization. Since India is anybody who is a signatory to WTO, they have to follow the rules prescribed by WTO. If somebody doesn't follow it, then any member country can complain against other country. So in this case, the case in point is MEIS, the scheme which was existed prior to 2021. Against that, the US government has filed a petition stating that this is not a remission scheme. As such, the government of India is not compensating any taxes which are actually incurred. So the earlier scheme used to give 4 or 5% based on the value of exports, for which there was no there was no calculation as to why somebody is arriving at 5% or 4%. So this concept of calculating what is the VAT portion went into the exports, what is the electricity duty component which is used in that export product, etc. This back of the envelope calculation was not there, and straight away a single percent of scripts we used to get under the MEIS scheme. Therefore, the US has filed a petition, etc., and then we got an unfavorable order wherein we were to withdraw this scheme. So we have to discontinue this scheme since we are part of the WTO. So given that the government has introduced this scheme from 2021, ideally it is supposed to be introduced from 2020, because of COVID or whatever reasons it could not be done. So the major shift from the previous MES scheme and this is that the amount of benefit was reduced drastically. Earlier, for suppose if I am exporting steel, so there was about 5% of MES scrip. Under the RODTP scrip, it is reduced to 1 or 2% of the value of the export goods, because that's the only amount which I am paying, for which I am not getting credit. So that's about it. So that's the background about RODTP. So this has come in because the previous MES scrip scheme was litigated at the WTO. So coming to scope, so it is applicable for all products except for those products which are covered under another scheme called ROS TCL, which is meant basically for textile exporters. If I am exporting a textile, again the taxes which are involved at the local level are slightly different. So therefore for them there is a separate scheme, and that was introduced even before RODTP. Okay, so if the goods are textile related, then that are not covered, but all other things are getting covered under the RODTP scheme. And then if there are specific exporters, suppose if somebody using say a scheme called advance authorization, which we discuss in the next couple of slides, and basically if he is importing raw material without customs duty, or if he is using a scheme called EPCG where he can import capital goods without customs duty, so they are not eligible for this scheme because majority of it they are getting there. Sorry, earlier this was they are excluded, now they are also getting covered in this. So earlier whoever is covered under advance authorization or SEZ or EPCG, they were excluded from RODTP benefit. Recently, I think it's only a couple of months, from October or so from last year, it is introduced. So therefore, even these units can claim RODTP scripts. And then there are some exclusions wherein if it is a supply from DTA to SEZ, or if it is there are export goods with minimum export value or export duty, then those are not getting covered here. So the main point here is that, like, the single takeaway I think you can take from this is that these scripts are based on the value of exports you make. So basically you will get a certificate, and that certificate can be utilized for paying your customs duty. So the same exporter, usually exports and imports are linked. So if I am an exporter, I invariably use the imports also for my raw materials, majority of the cases, because that's how the supply chains are linked. So therefore you can utilize these scripts for paying your customs duty on imports. If for some reason if you don't have imports, then we can sell this script in the market, which is usually at a discount. Suppose if we get say we have exported some goods worth 10 crores, then we will get a scripts worth, say, which is 2%, we will get about 2 lakhs. Yeah, 2 lakhs, right? No, 20 lakhs, we will get 20 lakhs. So that 20 lakhs, we can utilize it for payment of basic customs duty, which is basically the cost. We will not get any credit. So that you can pay using the scripts. If for some reason we are not able to utilize the scripts because we don't have imports, or we are procuring the same product from a local supplier, then we can sell that scripts. Usually that is at a discount. So if the value in this case is 20 lakhs, we can sell at, say, maybe 5% discount. We'll get at 19 lakhs. 19 lakhs worth of it we will get in cash. So, and the same thing can be utilized by whoever buys it. He will get scripts worth 20 lakhs. Basically his profit is 1 lakh. And then if somebody avails these scripts, so then what is the process for availing? So process is pretty straightforward. Whenever somebody is exporting, they will have to file a document called shipping bill or bill of export. If it is through air or water, they have to file a document called shipping bill with the customs. And if it is through road, for the countries like Nepal, Bhutan, all that, that is called a document called bill of export has to be filed. So in this document we have to there is an option to check the box saying I will be claiming RODTP script. So the moment we claim it, check that box, and then the details will be processed by the customs at the back end, and then we'll get this script through based on our IEC, import export code. So once we get it, this is being maintained in the DGFT portal. There is a credit ledger, etc. Wherein, like the GST credit ledger, there is a ledger for this as well. So we can see it on a day-to-day basis, how much scripts we have got, out of which how much we have sold it, how much balance is there, etc. etc. So far, if you have any questions, we can take the questions on the go. So it need not be till the end. Okay, we'll move on. So then one key development with respect to these scripts is that so the new it's been announced only a couple of months back. So whoever is availing these scripts, they have to file a return called annual return, RODTP annual return, like the GST return. So the pain point there is that we have to give the details of those taxes which I explained in the beginning. The electricity duty, the VAT, paid on petroleum products, stamp duty, anything else for which we are not getting credit. So those details we have to give in the return, which I think most of the clients may not be maintaining because it's anyways hit to the P&L. Everybody may not be maintaining at a what do you call it, each head wise, like VAT, VAT, excise duty, electricity duty, etc., etc. So that is a one challenge, because in this return we have to give those details. The consequence of not giving those details is that the scripts may not be granted in future. So this is introduced last year only, last calendar year. So whoever has availed in a scripts in a financial year, so they have to file this return by end of that financial year. So therefore, for 24-25, whoever has availed the scripts, they have to file the return by 31st March 2025. So this is one difficulty as of today, because we have to see if this return format gets changed, because most of them may not be capturing those details which the format is asking for.
We have to ask, the duty we have to give only the details. We have to give the electricity bill so and so duty like that we have to give, or we have to upload the invoice copies also?
No, only summary level, working so like that number, how much. I think it is an exercise to see whether they are giving actual benefit or more. Suppose if somebody is getting say 10 crores of scripts in a financial year, whether their actual cost is 10 crores or it is less or more is what they intend to check. But the background is that before deciding this 1% or 2%, the Ministry of Commerce has their own methodology basis which they arrived at this 1% or 2%, because they take representation from the industry, various industries, and they'll ideally have factored in all of this while arriving at that script percentages. But I think they want to recheck it because of the budget constraints or whatever, so that they may reconsider the rates based on the data. Suppose if the overall scripts granted are say 10,000 crores in a year, then the data from the return only shows only 5,000 crores, then they may reconsider, I guess.
But it will not affect my script to whatever I have been received.
Yeah, currently it doesn't affect, but the condition is that if you don't file this return, you will not get scripts in the future. So that's the condition as of now.
Sir, if I do domestic local sales and then I export also, do they ask proportionately or like that or something? See, I do export.
Okay.
I sell locally also. I have only one electricity bill, for example. In that case, how it takes that?
No, you have to take proportionately. So the purpose of the return is that what is that
pertaining to export related
uncreditable tax which went to your export.
Export.
So that is it's a detailed working which we will have to do. It may not be available readily for most of the companies.
What is the awareness level of filing the outlet return amongst exporters community?
I think the exporters are aware. The only thing is the pulling the data is a challenge.
How can that be addressed?
How how can that be addressed is something, again, they look at us only chartered accountants.
Customizing the ERP.
Customizing the ERP may be one option, but this is a too small thing for somebody to customize the ERP, because in the whole, for a big company, export company, in the whole scheme of things, only for this return, customizing the ERP, that cost will be more than the script in some cases. So again, it depends on a case-to-case basis. Yeah, as you said, if it's a big company, they are claiming more credit, more scripts, then they have to. Otherwise, there is a lot at stake. If it is a small company, then they may take chance.
Cost records.
Sorry?
Cost records.
Typically, yeah, cost records. Or somebody is undergoing a cost audit, probably for them it may be an easier option. They'll have the data ready.
Can it include also something like municipal taxes also?
Sorry, sir?
Can the data also include something like municipal taxes also, or is it only that whatever only electricity duty, or only those are considered?
So anything broadly, electricity duty, VAT and petroleum,
Yeah.
then stamp duty. These are the three things which are majorly considered in the. That is the information they are asking for.
Not the state duties.
No, state duties. No, anyway, stamp duty is a state duty, so that information they are asking for. And the other condition, the final, there are two important things here. Is one is while we get script immediately after export. Like we export today, we will file shipping bill, then the process. Maybe in a month or so, we will get the script in the DGFT portal. There is no condition of realizing foreign exchange for getting the script. So we will get that script say after a month, and then immediately after that we say we have imports, we can utilize it. But the thing is that we normally under FEMA the timeline is 9 months. So we cannot wait for 9 months. Therefore, they are granting script immediately. Tomorrow, if they come back and say, okay, you have claimed these scripts, show me the proof that you have realized, we should be in a position to give. Otherwise, this has to be paid along with interest, like in any other government scheme. And the interest runs of is about 15% on a customer, 15% per annum. And the other thing is that these scripts can be sold if you are not able to utilize it. While for exporters it is okay. Suppose if I am only importing and trading, so I don't have any exports. Therefore, I am realizing I am depending on somebody. So I thought, okay, anyways I am getting a discount. Why can't I save some cost? So if we buy this script at discount, anyways, normally these are available at discount. The risk is that if the exporter has obtained it fraudulently, which we may not be in a position to check, so then the customs can go behind both of them, the exporter and the guy who has purchased this script. So this is a big litigation which is going on currently. So therefore, we'll have to put appropriate clauses in the contract so that if something goes wrong, you will have to compensate me for that. So yeah, these are the two critical things. One is 9 months. Within 9 months we have to realize so that we will not have to repay it back. I think which most of the cases it will happen, but unless if there is any non-realization, then again we may have to take RBI permission all of it to both ends.
So this includes any country, no sir? Nepal also, Nepal.
Any country. It is not country specific. Like maybe 10 years back, before 2015, these export incentives were country specific. There are groups, like various schemes were there. Now everything is clubbed into. Before this, there was a scheme called MEIS. Before that, there are many things like focus product, focus market. Like that, there are multiple schemes. So all of them are consolidated into one under MEIS. Same thing is carried forward now also. Briefly, that's about the scheme, RODDP. So if you don't have any questions, we'll move on to the next one. Next one is duty drawback. Again, this is on the input side. again, it depends on, well, calculated based on the output, but mostly whatever customs duty we pay on the goods, inputs basically. So there are two types of drawbacks. Yeah, before going to it, drawback is nothing but whatever customs duty you pay at the time of import, there is an option to claim refund of it if you export it. Okay, so then there are two types of drawbacks. One is under section 74, which is basically if you are exporting the same product again. You have imported XYZ product and if you are exporting it again. So it may happen typically, suppose if these goods have come for testing purposes, or you have genuinely purchased but there is a deficiency in it, therefore you have to return it. Or it may be for R&D purpose, it may be for whatever purpose, but the goods which have come, they are going as it is without any change. So as far as customs is concerned, whatever comes into India is import, therefore you pay customs. Whether sale has happened or not, it doesn't matter for customs. So therefore, even if you are imported for job work purpose or for testing, R&D, whatever purpose, you will have to pay customs duty. When you, assuming you are exporting the same product again after your intended purpose, so then you can, initially you have paid it, so therefore since these goods are being exported, I should not be penalized. So therefore there is an option to claim it as a refund. Okay, so we will get a refund up to 98% of whatever we have paid at the time of import, if it is re-exported as it is, without making any changes in it. And that 98% varies based on the time period. If we are exporting within 6 months, there is some percentage. I think maximum period is up to 18 months. So 0 to 3, 3 to 6, 3 to 6 to 9 months, etc. So up to 18 months, we will get a refund. After 18 months, there is no refund option. So therefore, if there is a issue with the products which have been imported, that have to be re-exported within that timeline to avail this benefit. The second thing is a drawback under section 75, which is the typical manufacturing exports. So we import raw material and then we use it in the manufacturing and then we export the finished goods. So the raw material, whenever we import, we will have to pay something called as BCD, Basic Customs Duty, cess and IGST. IGST anyways you get credit, we utilize in the GST returns, etc. BCD and the cess is something we don't get credit today. So therefore it's a cost. So it is world over. Every country, whatever customs duty they collect, that's how it is. Nobody gets a credit. Okay, so since we are utilizing it for manufacture of export products, that portion can be claimed as refund. Okay, so it provides for BCD and customs duty. In the first category, which is the re-export as it is, so there we will get all of it, BCD, cess and IGST, whereas in this we get only BCD and cess because IGST anyways we are taking as credit, and that we will get under the GST law. That is a separate provision for it. Yeah, so if these goods are exported as it is, we'll get about 98%, and then the key condition is that the IGST credit should not have been claimed. Since we are claiming IGST credit also, IGST also as refund, we should not have claimed it. If we have claimed it, then ideally we should reverse it. Okay, and then the process is similar to the how to claim this. The process is similar to RODTP script. We will have to select a box in the shipping bill or bill of export at the time of export, and then we'll have to file a separate application. Like in RODTP, there is no application separately. Here we'll have to, for this duty drawback on goods which are exported as it is without any change. So for that we have to file a specific application which will be looked into, and then it will be processed. It should typically take 6 to 9 months. It may be more also. But that's the situation. Then coming to with respect to customs duty drawback with respect to the manufactured goods. So whatever customs duty we have paid on raw material which went into the finished goods and then those finished goods are exported, will get duty drawback. There are three types of drawbacks there. One is all industry rate, which is the generic rate, like the RODD prescribed rate, which is determined by the Ministry of Commerce for across industries. Depending upon the product involved, they will determine it, and then that rate will be applied. We will get it as a refund, cash refund in the account. Okay, so then that is called all industry rate, which is generic rate. No need to make any specific application. We select drawback option in the shipping bill, then we get it as credit in our bank account in a month or so. Then this is like the first one, which is applicable for everybody. There is second thing called brand rate. When for certain products, if the all industry rate is not notified, then we'll have to make a specific application saying my product is not covered under all industry rate, therefore please look into it and then determine what is my drawback. So here there will be a lot of heavy lifting wherein we'll have to give again like the RODD return, we'll have to give details of what is my customs duty cost, BCD cost, which went into the value of export goods. So the maintenance of the cost records in this case also is important. If the product is not getting covered, then we'll have to make that application with that information. Like obviously without that information, they may not be in a position to process it. And the timeline for it is 3 months. So within 3 months from the date of export, we'll have to file an application wherein it will be looked into and then it will be done. The next one is the special brand rate, which is that in case our product is covered under all industry rate, but in our specific fact pattern, we are not able to recoup all the customs duty. So if it is say less than 80% of, say we have incurred a customs BCD of say 1 crore rupees, based on the duty drawback, I am getting only 50 lakhs. If I apply the percentage on the export value, I am not even getting 50 lakhs while I have incurred 1 crore as customs duty on the raw material which is used for manufacturing. So in that case, we can make a specific application saying the all industry rate, which is the generic rate, is not helping me, therefore we'll have to look at it separately and then we have to decide based on my facts. Okay, so again this here also we'll have to make a separate application which will be looked into and then will be decided. Typically again this also will take up to 6 months to 1 year, so that's how that's the pace at which customs work, but that's the situation today. And if somebody's export is a EOU or SEZ and they are exporting the goods, for them duty drawback is not applicable because typically they are not paying customs duty only. So therefore for them it is not applicable. And one key condition is that like implied point is that if somebody is only not a EOU or SEZ but a DTA, domestic tariff area, that is the word which is used. If somebody doesn't have any specific registration as EOU or SEZ, even if they are not importing any raw material per se, suppose if I am a manufacturer, I myself am not importing, but my supplier is importing. So therefore, he is not doing social service, he will include customs duty also and sell it to me. So the fundamental point here is that in my export product, if the customs duty is included, I will get duty drawback. Whether it doesn't mean that it has to go from my pocket. In the whole supply chain, if it is included, then I should be eligible for it. So that's why the rates are determined based on a particular HSN. Suppose if it is steel, then you will get so much of drawback. Everybody knows that India is not steel sufficient. It has to come outside India. Same petroleum. So most of the products, that's the situation. Okay, so that's one of the important point for this. So So even if we don't import ourselves, if the supplier is importing, we can still claim the drawback as long as it is.
For claiming, do we need to submit that we have imported certain goods from China? So,
No. So if it is getting covered under the all industry rate, so the only thing we have to do is in the shipping bill, check that option, then rest will be taken care by them.
Even if the custom duty has not been paid on the raw material, suppose, but the tariff rate is there.
Okay. Tariff
You are
rate.
saying it is covered under the industry rate.
Correct.
Suppose there is 5%,
Hmm.
and the goods you manufacture through the raw material domestic purchases, procurement from the domestic sources.
Hmm.
No duty was paid on the custom, but still it is covered under HSN code.
Yeah.
So will you get the this?
Yeah. If our HSN is covered under the all industry rate, then we'll get that duty drawback benefit. It might also happen that you might not, the supplier, the exporter might not have imported directly.
No,
His supplier.
even if that material procures totally from the domestic, no where it was imported from anywhere, throughout the supply chain.
No, if it is covered in the all industry rate, maybe if it is a say homegrown product, then it might not be covered in all industry rate also. Okay, say if say there is a raw material which is available only in the country, so that, and then that is used in a finished product, that may not get covered in the all industry rate. In the back end, they might have done that analysis, but we as exporter, we just have to see the all industry rate. If our export product is getting covered under that list, then we are eligible. So the exercise whether the export of this product is using imported material or not is done by the government. So there is no responsibility on our side that okay, we have actually used imported raw material.
So the classification becomes very important.
Classification of the output. Yeah, the export. Yeah.
Exporting product classification.
Correct.
Correct HSN code.
Yes,
Very
that becomes very important. In case, again, they do have mechanism for it. There is something called as RMS, Risk Management System. So based on the description, if we are declaring, majority of the cases, if we are declaring incorrect HSN, they do have mechanism to track it. And if it is not getting tracked at the time of export, if they track it later, then there will be a penalty, etc. for wrongfully claiming. So that thing is there. Sorry, I can't hear it anymore. See the idea. Understood. So see the objective of this scheme is that whatever customs duty which got incorporated in the value of export products, so that should be compensated. You cannot export taxes. You export only goods. So don't include tax value in the goods. So that's the whole agenda of getting refunds under the indirect taxes. So in this specific case, if if that product has not suffered any customs duty, then that might not get covered under all industry rate. All industry rate is a very big list. HSN wise.
Suppose it is covered.
Now, if it is covered, then we can claim. As such, there is no restriction in the law that for claiming you should actually have paid it. That condition is not there. The only thing is your product is getting covered under EIR, we can claim it.
Thank you.
Thank you. And other ineligible category is if there is negative value addition. So in some cases it may so happen if it is between say group companies, if there is negative value addition, meaning there is no profit. So they have imported that they are selling at a loss for whatever reason. In that case, we will not get duty drawback. In case of manufactured goods. And similar to RODTEP, the condition also here is that we have to realize we will get the drawback immediately within a month or so, but we have to realize it, the forex within 9 months of payment time. If we don't, then again same thing, recovery proceedings may get initiated. Then the third refund scheme is that GST refund, which is popular, GST refund on account of exports. If somebody is exporting goods or services, then we have two options: export them without paying GST under a document called LUT, letter of undertaking, and second option is export them with payment of GST. Okay. So suppose if somebody has chosen the first option, export without payment under LUT, then they can claim the, okay, so to just come back, to take a step back, if somebody is exporting goods or services without paying tax, since he might have procured goods or services for generating that export, he might have paid GST. So, and he might have taken input credit also. So that will be lying in his credit ledger. So that if that is not refunded, then ultimately he will recover it from his customer. So therefore, that fundamental principle which says you cannot export tax. So you will have to give the tax back as refund if somebody is into export. So therefore, in the first option, where if somebody is exporting without paying GST under LUT, we can claim refund of the input tax credit. So since they are in the export business, they are not able to utilize the credit, so they can claim it as refund. The second option is export it with payment of GST. For paying that GST, you utilize input tax credit. Okay, it might sound similar, but there are slight nuances, like slight differences in both of them. I'll just come to it. So in the second option, say we are exporting 1 lakh worth of services or goods, then we'll have to pay, assume 18%. That 18% instead of paying through, and like in domestic transaction, what we do, we pay that 18,000 as credit if we have credit, otherwise we will use cash and pay it. So here also we can do the same thing. The only difference is that 18,000, what you are paying for export of goods or services, you will get refund in cash. Even the first option also will get refund in cash of ITC. There are slight differences in both of them. So in the first option, when we are claiming refund of ITC, there is a formula which is ITC into export turnover by total turnover. How much of ITC you are utilizing for your export business, I will give you that refund. The catch here is that ITC, while calculating that ITC, we will have to take ITC only on inputs and input services, not capital goods. So will not. So in a way, if we are choosing first option, we will not be in a position to get a refund of ITC on capital goods. So for any business, maybe for service business, capital goods may be less, but typically for manufacturing businesses, capital goods are required. So in option number 1, we will not get the refund of ITC on capital goods. So the formula goes like this: ITC into export turnover by total turnover. ITC excludes capital goods credit, and the export turnover is normal export turnover if it is goods or services, and total turnover is your all turnover, exempt, taxable, everything. Then the other point is that we can apply for refund in case of export of services only after realizing. This is a slight deviation from the first two schemes, drawback and RODTP, where we can claim immediately before realizing, whereas here for services we can claim only after getting the forex, typical, depending upon the credit period, 3 months, 6 months, whatever. Okay, and for goods, again for goods there is no condition. We can claim immediately ITC refund if you are exporter of goods. Even if you are not realized, we can file for refund. The same 9 months timeline here also applies. You get refund today, but you don't realize the export value of goods within 9 months, then you will have to pay it back. The one variation here is that the value of the export turnover for goods while calculating, it should not exceed 150% of your domestic value. Suppose if you are exporting a product, say if you are exporting a phone, if that phone is sold in the export market at say 1 lakh rupees, no, if it is sold at 1 lakh rupees in the domestic market, it at least should be 150% more in the export market.
It should not be more than.
Sorry, yeah, it should not be more than 150. Yeah, no, sorry, it should be the other way around. Suppose if I am exporting a product as 1,50,000 in the export market, that value should be at least 1 lakh rupees in the domestic market. So it should not be more than 150% of your local sale. So if it is more than that, then they will not consider in the formula, in the numerator. Suppose if you have exported at 2 lakhs, they will consider only 1,50,000 in the export turnover, therefore we will get less refund, which I think there is no logic only. So for 2 lakh, if we am getting more forex to the country, I should be rewarded, but in this case the exporters are not getting rewarded even if they get more value than the domestic value. Like if they are selling say a phone in domestic market at 1 lakh, they should not sell more the same product more than 1,50,000. That's what the government is saying, which is ridiculous. Then the other option, which is exporting with payment of GST, we can pay that GST on the export value using ITC. This ITC includes all the three. We can utilize capital goods credit or inputs. Inputs are basically your raw material or any goods, and your input services, any services which are used. So by using second option, if somebody is in a capital intensive industry, so they will be in a position to liquidate that capital goods credit. Okay, so typically the all the industries which are served in the the B2C consumer durable products, so they import capital goods. Say if somebody is in say kitchen utensils or cooker or anything of that sort, typically they import capital goods from foreign country to manufacture it, and they sell in the domestic market, and sometimes they may sell in the export market also, because lot of the information which is available to the public is that IKEA procures lot of their products from India. So on a white label basis, many Indian players manufacture and sell to IKEA. So in that case, so they are say assume there is one player who is doing that. So somebody is importing capital goods, manufacturing this capital kitchen based utensils or whatever, which he is selling in the domestic market and also exporting. But he has imported capital goods for manufacturing it. So the capital goods credit he can recoup if he opts for the second one, which is exports with payment of GST. In the first option, that is not there. And so for most of them, this second option is available except for certain products which are specifically notified recently. Typically pan masala, unmanufactured tobacco, which are basically the unregulated markets, which are typically prone for evasion. So in those cases only these are not getting covered, but for most of them, this is majority of the cases, this option is available. And earlier there was a restriction that this option cannot be utilized by say export oriented units. So if there is an export oriented unit, if they have procured capital goods locally, they will have to pay GST. So that credit got stuck because they cannot claim under first option, because ITC definition does not include capital goods credit. Second option, there was a restriction for EOUs till October last year. Till October, November last year, this restriction was there. After that, this restriction is removed. So this was one challenge that is removed on a prospective basis, making it easy for them to claim capital goods credit also.
Is it a way to use 1 year capital second option and next year can I opt for first option?
Yes. In fact, not even year wise. We can use it transaction wise also. Suppose if you have 50 export invoices, so 5 invoices I want to use option 2, 45 I will use first option. That also can be done. Within same month also I can do.
So then in that case, I will do partly with payment and partly without payment. When I am calculating the different calculation, export turnover without tax, whatever I did, for the purpose of refund, ITC refund. In that case, the total turnover will be, I mean, how
without, in the numerator you will get only without payment, whatever
Yes.
you have done without payment, that only gets captured in the numerator. What is done with payment, that should not be captured. That's the formula.
that
That's
is
how we
almost
want.
equal to domestic turnover, then we have to see for the purpose of the
Second,
formula.
No, formula says net ITC into export turnover. Export turnover is without payment of GST. Whatever exports you have made without paying GST, you include. If you have exported certain services or goods with payment, it should not get captured there. So, but everything gets captured below in the total turnover without payment. So, proportionately the formula will take care. So, we will be eligible only for that.
So practically, are they doing the transaction wise also? Outside they are doing. But
Transaction is also there.
It is very tough to maintain a track of if you keep on switching the options from option 1 to 2 to 1. Transaction wise.
Oh, no, it's not difficult. We can maintain as long as if the volume is like the refund is substantial, then. But as such, there is no much details we have to give to the department per se. The only thing we know from the sales register or ERP, we will know which we have done with payment or without payment. So first step is that. Second step is ITC is common for everything. And then in the denominator, we will include everything. Okay, as such, for us it is not difficult. For the officer to verify whether we have included this in both places is what it is difficult for them. That also it's not impossible. They may find some difficulty, but it's okay.
Would you say if you go for option 1, the reality bond, you can still use option 2 as and when required?
Correct. But you have to use it either option 1 or option 2 for a specific transaction. Yeah, we have one invoice that has to go choose either of it. Because in invoice we have to accordingly mention export with payment or without payment, that we have to give a declaration in the invoice. Same thing we have to do in the GST return also. Yeah, the procedure for this is that if we are choosing option 1, which is without payment, then we'll have to file a separate application. Whether it is for goods or services, we have to file an application called RFD01, etc. It gets processed usually in 60 to 70 days, which is much better than the old service tax regime, which used to take months, years to get refund. So like at least the process is streamlined when compared to the previous regime. As far as the other option, which is with payment, if it is export of goods, again it is much easier than the first option. Like the duty drawback or RODTP, this also gets transferred by customs, not the GST. So as long as the document the details are matching, invoice number, all of that are matching, then it will get processed in a month automatically. Data gets pushed from GST portal to customs portal, and then they will process it and give the refund. Even here also the same condition of 9 months applies. If it is goods, if we don't realize, we will have to pay back. For services, we can apply only if we realize. So services it is easy. For goods, once we get refund, people may lose track of whether we realize or not. But even that also will be taken care, because exporters have to follow the FEMA guidelines. Right? They will have to file if they are not realizing within 9 months, ED banker will be behind them. Then someday ED also will be behind them if you don't do. So. I think broadly we have covered the 3 refund schemes. If any question we can take, otherwise we'll, Sorry, I can't.
No, mic కూడా మళ్ళీ
Unjust enrichment. Yeah. See, this is something, yeah, for option 1, unjust enrichment is applicable, which says that you cannot take benefit, dual benefit. You cannot take dual benefit. One, taking refund from government. Two, taking refund from your, taking the same money from anybody else, be it your customer or any third party. For option 2, which is we are paying tax and we are recovering it, ideally, I'll have to check this, but ideally here also unjust enrichment should apply.
Pradeep, this is a classic case. Because in the flyers they have said it is not applicable for option 2. But the department guys are saying, hey, you have already recovered, it is sitting in your bank account. Why can't you pay back to the government? So, nowhere in the notification or if you read the act, it is not coming at a full base that it is applicable or not applicable. So, any live case you have come across or anything which you have undergone this kind of a trouble from the department, if you could throw some light on this.
Okay. No, as such, I have not come across any live case on this. I think if I am not wrong, there was a provision which says for SCZ supplies this unjust enrichment will apply or will not apply, then there was an amendment, etc. For exports, unjust enrichment as a concept, what the department is like, well, if it is not there in the law, then we can always argue, so there is no specific requirement. But conceptually speaking, to me, I'll have to recheck, but to me it appears that unjust enrichment applies here also. If you are taking the refund from government, why are you recovering the same thing from your customer who is located in abroad? The fundamental objective that you should not export taxes make it difficult.
Thank you.
I can answer the question.
Yeah, please.
So I think unjust enrichment is applicable in both cases. In the option 2, when you're raising an invoice to your, let's say, a holding company or anyone outside, you will not include the IGST component in the invoice which you will share. It's just a matter of you including in your GST 1 and 3B.
Yes.
That's the only thing. So the unjust enrichment answer, I think it's answered over.
No. While we may include only GST or 1 and 3B,
you will not share it with the customer or
that's what. Some clients, what they do is, the same GST invoice, they will send it to their customer also. Like for some of
over there, that will be applicable.
That may be applicable, or if they are like not a seasoned setup in terms of if it's a small MNC, they don't know much.
It's a one-to-one correlation between your invoice and FIRC. Then obviously any officer will easily get to know whether if I raised 100 and if I got 100 in an FIRC. If I got 118, then there's an issue which obviously they will catch up.
No. Typically, so what's the practice all the big companies follow is that they give one commercial invoice which excludes taxes, and then this GST invoice they will record only maintain for their records. As in they don't share it. If they share it, then if they recover it, then ideally
that's enrichment anyway.
Then you can just maybe quickly we have small illustration.
Hello, so one question.
Yeah.
Being a EO unit can claim GST refund, ROD and also all India duty drawback, all India state duty drawback.
All three.
All three.
All three you can claim.
There is no unjust.
They are different. Yeah, they are different.
And can we claim this one refund on capital goods also? Recently we spoke now.
Yes. See, if you are an exporter, so if you are an exporter, your RODTEP will take care of taxes which you are not getting credit today, which is your petroleum, VAT, all of it. Duty drawback will take care of your customs duty, again you don't get credit. GST refund will take care of your GST credits, which is anyways getting recorded in the returns. So all three are...
In that I can claim capital goods also.
Capital goods you can claim if you are doing option 2, which is with payment of GST.
Can I claim this terminal excise duty?
The terminal excise duty thing is basically for petroleum products. Again, today if somebody is selling petroleum, excise duty has to be paid. That is, that term used is terminal excise duty in foreign trade policy. That also you can claim as refund if you are supplying to specific suppliers or specific customers like UOU, whoever is holding advance authorization. That is also quickly covered here. So that is called deemed export under foreign trade policy. If we are manufacturing any goods and supplying it to specific customers like advance authorization holder, if you can see in the slide on the right side, advance authorization holder, EOU, towards my right, I think for you also it is right. So advance authorization holder, EOU, or the finance projects financed by World Bank, etc., etc. So in that case, we get refund of excise duty also, which is paid on petroleum products or tobacco. Okay.
This is in addition to this RODD.
This is in addition to RODP is to address your export needs. If you are taking goods outside the country, this is deemed export is goods are not going outside the country. They are supplied within the country to specific customers.
Yeah, suppose I supply to the EOU, can I claim that?
You can claim. If you are supplying to EOU, you can claim TED, terminal excise duty.
Hello. Sir.
Yeah.
For the export, we in method 1, we don't get the input for the capital goods. In the second method, we get the capital goods input. So can we switch in the next year, like without LUT and 1 year for LUT? Can we do a plan?
Yeah, we can switch. Even we can switch next year, or you can do both options in the same year, same month. Only thing is same transaction we can do.
Okay. Input should not be overlap, but
otherwise we can. There is no restriction.
Okay. In the quarter, next quarter also we can do that. Even with having the LUT, we can say that without LUT, we can pay the invoice.
Yeah. That's why typically people does it. Like suppose somebody has imported capital goods or procured capital goods in a particular month.
Okay.
So they have huge credit. So what they will do based on their sales product projection, they can recover only in next 12 months. So it's a working capital blockage. Therefore, they may opt for option 2, so that they will get the money.
Whatever the tax they need to pay, that should be in the same month in the capital goods is procured.
No, it need not be. It need not be. So the capital goods credit will form part of your pool credit ledger, and that can be utilized whenever. Whenever you are exporting the goods. Today, say you have imported capital goods in January, then the goods are manufactured and they got exported only in April because 3 months time it took. So while exporting in April, you can utilize this credit, or maybe you have not only there is no one-to-one correlation also. Meaning using this capital goods, you have produced say XYZ product, and you have another ABC product also. So no one-to-one correlation is required. ABC product is getting exported next month only. So next month you can pay utilizing this credit. So immediately you can utilize as long as you have export of goods or services. So quickly there is a small illustration, option 1, option 2. We can see, suppose if there is a supplier who is doing export of service, the value of the service is 1 lakh rupees. So under option, both options, the value of service is same. Domestic service, assuming he is doing 25,000, the domestic services value. If he choose option 1, he will not pay any tax. If he choose option 2, he will have to pay 18%, which is 18,000. So then, like these are the facts. So if the total, say they have a total turnover of 1,25,000, and export turnover of, so total turnover is 1,25,000. If you see, export turnover is 1 lakh, domestic is 25, 1,25,000 in both options. And coming to ITC, assuming that 1 lakh is realized, they have FIRC or BRC, then the ITC availed on 3 things: input services, attributes is this is the breakup: 3,000, 5,000, 7,000, which is close to 15,000. So if they choose for option 1, they will get only a refund of 6,400, because the formula is export by total into ITC. Here ITC calculation will take care of only 8,000 against their total ITC of 15,000. Okay. So whereas So by that way they are going to get only 6,400. Whereas in option 2 they can get a refund of, so they'll in option 2 they'll pay 80,000. That 18,000 will be utilized, paid using this credit which they have, like about 15,000 they have credit. So that credit will be utilized, and they'll have to pay balance 3,000 in cash. So the liability is 18,000, they have credit of 15,000, balance 3,000 they have to pay using cash. So that entire 18,000, okay, so 18,000 is not relevant, so entire 15,000 they will get it as a refund, because 3,000 they are paying from pocket. I think that here that row 2, like column, last column is incorrect, that it should not be 12,000, it should be 18,000. In their 18,000, whatever they have paid, they will get. Out of 18,000, they can pay using credit about 15,000. So that way, in option 1, they are getting only 6,400, whereas in option 2, they will be getting 15,000 as a refund. So the basic impact is because of the capital goods credit.
6,400, how you are calculating?
6,400 is 15,000, not 15,000, 8,000, which is on inputs and input services. 8,000 into 1 lakh by 1,25,000.
1 lakh 25. 1 lakh 20, sorry.
1 lakh 25.
What is it? Means at the end of refund period, what is that end of refund period?
So this is another thing. So it might have so happened that if we have domestic turnover also. So in this example, so 15,000. Okay, for option 1, what is relevant is 3,000 plus 5,000. So out of that, if I have domestic turnover and I have exhausted all the 8,000, so then I should not claim refund from the government, because there is no value which is, there is no credit which is stuck with the government. So
refund period is
refund period meaning, so it may be 1 month or quarter.
There is a due date of getting refund, or it is the actual refund? What is it?
No. So okay, we say we have done exports in January. Okay, and then we can file refund for January month. So after filing January return, what is the balance?
That is the end of refund.
Yeah, that is the end of refund period.
Sir,
So you are filing refund only for January, assuming. Okay, you have exported goods in January. You have credits which are, you have procured goods or services, utilize it
At
for
the
that.
time of filing the whatever the returns for refund.
Not at the time of, there are two things. So in this case, assume we have exported goods in January. Option 1 is immediately after filing the return, which is 20th of February, you can file the refund claim. Or option 2 is you can file whenever you want, within 2 years. 4 or 10 is 2 years. Assuming you are going to file immediately. So in this case, L and M will remain same. So you will be filing refund for January. After filing January, what is your credit balance in your credit ledger? Okay, suppose if you have more domestic turnover than your export turnover, you may exhaust the entire 8,000. In which case, this L credit balance at the end of refund period may become 0 also. But the idea is that
at the time of filing the application, whatever the status is there.
Correct.
So at the end of refund period, instead of that, it could be written at the time of filing the.
There are two things, that's why. Column row M takes care of. Ours is a classic case. Like in an ideal scenario, you may file in one monthly basis. Somebody will not, if they have recurring exports, they will not want to file monthly. They will file quarterly or yearly. So in that case, you will have to deal with two numbers. One is after filing, say you are filing for January to March quarter of 2025. In next year, 2026, you are filing. Assuming April 2026, you are filing. So after filing these 3 months returns, which is March 25, what is your credit balance looking like? Say your formula is giving you 100, whereas your credit balance after filing these returns is only 80, because you have more domestic turnover, you have utilized the credit. Okay, and you are filing the return, that refund application in 2026 April. That time the credit balance is further went down, assuming, say only 60, 100, 80, 60. So then we'll get least of these three, because the whole point is that how much credit is accumulated because of exports. If you are utilizing some of those credits for your domestic turnover also, then in a way you are getting compensated, so I will not give you refund. So therefore, three numbers are considered. What is the formula giving, which is credit proportionate to your
One explains the credit balance at the end of due date.
at the end of refund period. So in our case, refund period is April to March 2025, assuming. After filing these three returns, what is your balance looking like? So in the same example, balance assuming is looking like 80, whereas the formula export turnover by total turnover into ITC is giving you 100. So you are balance.
If you are filing for Jan, Feb, March once, so at the 31st March will be the end of the
Yeah, right. Not 31st, because practically 20th of April.
It's next following.
The following month, because we will file only on 20th. After filing that return, if your balance has come down to 80, that means 20 of it you have utilized for your domestic turnover. So therefore they will not give refund. So they will give only 80.
So in this option one, we already claiming 3,000, 5,000 rupees as the import. So we already claimed we got a benefit on that. Apart
Benefit meaning it's only what it is lying only in the credit ledger, right? It will, as long, suppose assuming we don't have
against domestic services we are
yeah, if we are utilizing from domestic services, then that will be taken care
by the formula.
The not formula, here below last column L, credit balance at the end of the refund period or on the date of filing. There it will be taken care. If you have utilized for your domestic turnover, that balance will automatically come down. The formula says what is the credit proportionate to your
That's 80%.
exports.
80%.
Yeah.
Actual date of filing can be prior to refund period and also after the refund period. Actual date of
Usually
filing-
after the refund period. No? So after exporting only.
No, means suppose it is the 20th April. Refund period you said keep to 20th April. The return can be filed on the 1st April also.
You can file 1 and 3B you can file, but
So
practically
that
it is
can
not.
be before and after also.
Sir,
Actual date.
sir, if I am filing for April to March, April to June, sir, I mean, in for example, Jan to March, I can file only after March 31st. Subjected to that, your 3B is filed.
But what I am saying, the date of filing can be even after the refund period, after 20th also.
Yes, sir. Even after 3 years also, I mean, after 1.5 years also, you can
And
post.
that also can be on the very first day also.
Yes, subject, your 3B should be filed, sir, before filing.
Yeah, practically we can file only after 15th because your 2B will not get generated. So on 14th only it will get generated. So. Quick time check, sir. So briefly, maybe I'll just briefly I'll cover the other things. Just tell the basic concept then, so that it will you can consider it in future if required for your clients. Exemption schemes, basically this allows us to import goods without paying tax, without paying customs duty. First thing is EPCG, which is export promotion of capital goods. You can import capital goods without paying customs duty. The only condition is that since government says that I am allowing you to import capital goods without paying customs duty, you have to export. You have to give a commitment that you will export so much. That commitment is 6 times. Suppose by importing capital goods, we have saved 1 crore of customs duty. Our minimum export should be 6 crores. Over a period of 6 years, we have to export goods worth. Goods are services. This can be utilized even by service exporters also. Anybody who is doing export, they can utilize EPCG, whether goods or services. And here, we have, there is a requirement of, so this can be utilized even if you are procuring from locally. Suppose if you have a EPCG license, then you can procure, based on the EPCG license, you can procure goods locally also, where we will get only benefit of GST. Okay, so we can procure from local markets under EPCG license without paying GST. But classically, majority of them use for imports. Okay, that is one, and then the other condition is 6 times. So the main condition is that there is it is called nexus. So if you are importing capital goods, saying I am importing XYZ capital goods for manufacturing ABC, then our export product should be ABC only. So if there is no nexus link between your input and output, then they will not consider. Suppose if the same capital goods can be utilized for some other product. The first product, initially we implemented, okay, somebody plans to enter into a market, export market. Say somebody wants to go to Southeast Asia, they want to test out, they are into consumer products, so they want to test out the market, so therefore they want capital goods, they will import, manufacture here and export it to that country. It might have so happened that the plans got changed, that they will not be in a position to sell in that market, but they have imported capital goods. Okay, so the export, this is it is called an export obligation, whatever 6 times point which I said, it is called an obligation. So that will be considered only if I am exporting that same ABC products. If I am exporting using it for some other thing, they will not consider it. So that's a stringent condition. So nexus is like mandatory. So you have to utilize it for the same output.
So 100% you have to export?
No, not 100%. See, we'll have to, yeah, you can see quickly see the illustration, you'll understand. So, so suppose if somebody has exported a product and the customs duty they saved on account of importing under EPCG is 1 crore. So the condition is that they have to, their exports value, they have to export goods or services worth 6 crores in next 6 years. Assume they have got it today, next 6 years, they have to achieve export turnover of 6 crores. Okay, they can have domestic turnover also, that is different, but minimum they have to do this. Apart from that, assuming they have, say they are exporter already, their monthly average export, annual average export is 2 crores. Even without this scheme, they are normally doing export. So they have to maintain it. So because of this scheme, incremental, what is the export you are making, that only will help consider. Previous thing also you have to maintain. So in this illustration, if somebody is exports are 2 crores per year before taking the scheme, they have to maintain the 2 crores per year and achieve this 6 crores, which is 6 times of the duty saved. So overall, so if you take 6 years, their export should be minimum this much. 2 crores, which is their already average, previously whatever, their performance should improve. They cannot claim benefit for the previous performance. So their performance incrementally should improve. The 2 crores into 6 and the 6 crores which is relating to this thing, the actual capital goods.
Sir, I have one doubt. See, I have a machinery and I am doing exports. As if for example 2 crores per year, I mean per month I am doing 2 crores. Now that machinery has some problem, I kept out, I scrapped it. Now again immediately I imported. So because of this new machinery, I am doing this new 2 crore turnover again.
Import was only for replacement. Import was only for the existing equipment replacement. So there is no increase in the export. The same amount of same volume of the export is happening. Suppose I was using existing domestic equipment and that was not working. So he replaced the existing with the imported capital goods equipment. And now but the export turnover remains the same.
Export turnover remains the same. See, while so this specific, this is like the average thing is called average export obligation. That is the terms which are used. And then this 6 crores is specific obligation in this case. So average obligation will be determined based on the past performance. In case you want get this tweaked or anything, we will have to make a separate request. But to my mind, we may not get a benefit for that. I'll have to check this. I'm not sure about it. But average export, the previous performance has to be maintained. As far as this point, I will check. Same thing, there is a similar thing, this is for capital goods. So we can get capital goods without paying customs duty, subject to we export some value, which is 6 times. Same thing for raw material is also there, which is called advance authorization. Conditions are similar. The only thing is we get timeline of 18 months here. Within 18 months, the obligation period is typically 18 months. Again, there are variations to it depending upon industry, etc. Some is gems and jewelry, various industry, various periods are there, but majority of them 18 months period. The other thing is that when we are importing raw material, there is a thing that say we are importing raw material worth $1 lakh. So there should be a value addition. Otherwise, what is the point of giving exemption? So the minimum value addition is 15%. So if we are importing $1 lakh, our value addition should be minimum 15%. So our export value should be again 1.15 crores. Then while giving that permission, they will take into consideration if there is any wastage, etc., like input-output ratio they take. So based on that, what is, say for producing 100 units, how many units of your RM is required, that wastage, etc., also they calculate. Based on that, they will give the permission. Then on the value what we have imported, there should be a value addition of, minimum value addition of 15%. So in both cases, like we will get a license, and then after exporting, we have to file an application saying we have exported as per this license. These are the details. So we will have to give the actual export invoices, bill of this DRC, all of it, so that they will this license will be closed. So in foreign trade policy, there is a stringent provision which says that if there is a violation, they can levy a penalty as high as 500% of value of goods involved. So that's a big thing, but usually they will not charge that much, but that provision is there. 5 times the value of goods, that is the provision which says that. So foreign trade policy, there is it is governed by FTDR Act, Foreign Trade Development and Regulation Act. Then the last option is deemed exports. Basically, if we supply within the country, also we can claim some certain refunds. Say if we are saying both of, so deemed exports is defined both under GST law and foreign trade policy. Both of them meant the same thing. You supply to specific customers, I will give you some benefits, even though you are not exporting. Under GST law says that if you supply to somebody who is holding advance authorization or EPCG, which we discussed now, or somebody who is EOU, or supply of gold by a bank to a advance authorization holder. Anyway, so overall, if you are supplying to EOU, advance authorization holder or EPCG, you will get deemed export benefit under GST law. So what does that mean is that you can get refund of GST. That refund, so the moment you supply to advance authorization holder, EPCG holder or EOU, the GST, whatever you pay to the government, that can be claimed as refund either by your customer or the supplier, basically. But it involves a procedure, you have to file documents, etc. But this option is there. And similarly, under foreign trade policy also, if somebody is supplying to these guys, slightly the scope is wide here. Even if somebody is supplying to EHTP, Electronic Hardware Technology Park, or STPI, Software Technology Park, or to projects which are governed by funded multilateral agencies. Typically, all this metro rail, all these big infrastructure projects are invariably get funded by these guys. So therefore, if you are supplying to them, you can claim a deemed export benefit under foreign trade policy. Under foreign trade policy, deemed export benefit is basically you will get, again you can get EPCG even though you are not supplying, you are not exporting. EPCG, so for supplying to, so they say that infrastructure project within the country, I need a big, say somebody has got a big road contract. So for laying the road, all that, they usually buy from foreign countries. So for that, they can import under EPCG. Even though they don't have exports, they can import under EPCG without paying customs. Similarly, the raw materials, if any required also, they can under advance authorization. Then they can claim drawback also, duty drawback also. So briefly one example, suppose if there is two companies are there, ABC and XYZ, say they are manufacturing and they are supplying to same EOU, ABC and XYZ. Under, so assuming ABC Limited has availed, they intended to avail benefits under FTP. So under foreign trade policy, for supplying to this EOU, they can procure raw material without paying customs duty under advance authorization. Okay, or they can import capital goods also. Then the other things, duty drawback, terminal excise duty benefit. Suppose if there is another company called XYZ, they are selling it to the same UAE. Okay, then so they are intending to claim under GST law. So they can claim under GST law, which is basically the GST which you pay on your transaction, the sale value, you can claim as refund. If you see, FTP takes care of your input side, GST takes care of your output side, and both can be clubbed and both can be claimed. So these are not mutually exclusive because these are addressing two different things. So FTP is taking care of your input side, inputs which are getting into your manufactured products, and whereas GST law is taking care of your GST which is paid on the transaction value. So, and the key condition for both of them is that the goods should be manufactured in the country. So that's the main thing. Like if you are doing trading, if you are importing from some other country and then do a supply, then you will not get this benefit. Yeah, so that's briefly about it. So if you have any questions, you can take. Thank you very much for being very interactive.
Contact details are here. Great. So we just now had a very informative session from our colleague Reddy, where we saw how to increase our bottom line by utilizing the various incentives and refunds available under the indirect taxes. So now we move on to another important topic where our focus is more on how to safeguard the bottom line from eroding because of the penalties for whatever reasons it will be levied under the e-way provisions. So the topic is practical issues in e-way bill and detention of vehicles. This topic is of particular importance because the provisions in relation to this movement of goods provide the powers to officers to levy penalty up to 200% of the tax payable, or in some cases the penalty may go up to 50% of the value of the goods which were under movement. So as compared to section 74, which we were all considering as a very tough provision because penalty goes up to 100%. Here we have penalties going up to 200% and 50% of the value of the goods. So it's very essential that we give a careful consideration about the various do's and don'ts under the e-way bill provisions of the GST law. As a matter of fact, it's been 6.5 years, 7.5 years since GST has come, and most of the judgments under the GST law which has come to date, it's under e-way bill provisions. Taxman alone has published or reported close to 760 cases across various high courts in India. So just imagine 760 cases in reported in 7.5 years. There would be, if you consider the cases where the taxpayer was able to or managed to get past the authorities by whatever reasons, the number would be even higher. So our aim today is to discuss the most common issues which are being picked up by officers while they intercept the conveyances in the routine checks. what the courts have to say in these common issues, what is the opinion of the courts, and what are the possible remedies that are available to taxpayers to safeguard or avoid any possible conflicts or loss. So my humble request is that if there are any doubts, queries or any inputs that any of you may have, anytime during our discussion, please feel free to add in at the same time and need not wait until the end of the session. So to start with, let us understand the legal provisions which cast a duty on taxpayers and at the same time provide powers to the officers in relation to various aspects surrounding movement of goods. Then we will move on to see what the various major issues are and basically the issues that are arising between the department and the taxpayers in relation to movement of goods. So the enabling section which mandates what the goods, how the goods should be moved, what are the documents which are to be carried along with the goods is section 68 under the GST law. So this 68 comes under chapter 14, which is the chapter which covers all the provisions in relation to inspection, search, seizure and even arrest. So chapter 14 covers 67 to 72. Our topic is 68. So this is the enabling section which provides the powers for officers, proper officers again, to intercept the conveyance for verifying the documents and devices on board the conveyance. So documents and devices. So why do they intercept? For verifying the documents and devices, whatever is you carry on the conveyance which is being moved. Then we have section 129 under chapter 19, offences and penalties, which prescribes the provision in relation to detention, seizure, release and applicable penalty when any prescribed provisions in relation to this aspect has been violated. Then under 68, we have 7 rules for providing the procedural aspects from 138 to 138F. They cover various procedural aspects as to who has to generate e-way bill, when it has to be generated, what has to be contained in the e-way bill, how it has to be verified. So we will discuss all those in the detail in the coming slides. So while 68 was operational right from 1st of July 17, e-way bill provisions, that is the operational or the effective date from which e-way bill was made mandatory to be carried along with any conveyance was only from 1st April 18 in case of interstate goods and 1st June 18 in case of intrastate movement. So once it was introduced or rather made operational, the CBIC issued Circular 41 detailing the procedure to be followed during interception and inspection of conveyances. So this was issued in 18 and we are in 25 now. The only amendment which was made in 2019. After that there is no amendment to this circular. Another significant circular is 65 which provided some relief to the taxpayers in case of minor mistakes for escaping the penalty under 129. We will see all this. So this is just an overview of what we will be discussing today. So I have tried to summarize what the provision says rather than just reproducing it as it is for the benefit of all. The provision says the government may require the person in charge of a conveyance to carry with him such documents and devices when the value of consignment exceeds a certain amount. We will see in our discussion 138 rule, what is the device, what are the documents, what is the value. Now, why does the government want us to carry these? What is the purpose of this? So, as we all know, upon introduction of GST, the physical barriers or commercial tax checkposts, as we all know previously, they have been removed. They are no more there. So to validate whether the movement of goods are happening as per the provisions of the law and there is no escapement of tax, by way of road checks, this provision of section 68 has been implemented. So how will these documents be verified? The proper officer is empowered to intercept the conveyance. That conveyance in the sense it's a vehicle which carries the goods, and ask the person in charge of the conveyance. Person in charge of the conveyance is generally the driver, to produce the documents. So what is intercept or what is interception? This is not defined anywhere in the GST law, but as we generally understand, intercept means to stop or obstruct the movement of something or someone. So the officer can stop the vehicle and ask the driver or the person in charge of the conveyance to produce documents and devices for verification. Next, under 68, we have 7 rules, 138 to 138F, which prescribe various procedural aspects in relation to e-way bill. Who has to generate, when it has to be generated, what has to be mentioned in the e-way bill, how it is to be verified, so on and so forth. The most important and elaborate among the 7 rules is Rule 138, which prescribes the information that has to be furnished in the e-way bill and prior to the movement of goods and generation of e-way bill. We will spend some time on this because this sets the base for our subsequent discussion of case studies and case laws. So, every registered person who causes movement of goods where the value of the goods being transported is in excess of 50,000 rupees must generate an e-way bill which should accompany the conveyance during the transport. So, some states have an higher limit for intrastate movement of goods. Karnataka is still 50,000, but if you see states like Delhi and Maharashtra and a few other states also, their limit for mandating generation of e-way bill is 1 lakh rupees. So you can transport goods up to 1 lakh without carrying a e-way bill if it's an intrastate movement. For interstate movement, it's uniform across India, it's 50,000. Then the e-way bill is mandated for every movement of goods. The general misconception is e-way bill is only for sales, not for any other thing. So it's for any movement of goods, be it supply, be it other than supply. So if you see the e-way bill portal, there are various options provided under both the types of transportation, on inward as well as outward. It provides the reasons to be provided as say for job work, for own use, or the transportation is being made for the purpose of exhibition or fairs. So these are the main purposes for which e-way bill has to be generated. And even in case e-way bill is mandated, if you are a registered person and you are purchasing goods from an unregistered person, then the responsibility shifts on you to generate the e-way bill. So 3 types of transaction causing movement of goods: supply, other than supply, and purchase from an unregistered person.
Is that taxable or exempted both?
Which one?
50,000 is the taxable goods or exempted?
I'll come to the, it's there, I'll come to the next thing. So how do you determine who's the person causing the movement of goods? It says, if you see the extreme left, every registered person causing movement of goods has to generate e-way bill. So who's the person causing the movement of goods? So it depends upon the commercial arrangement what you have with your, what the customer and the buyer has. So basically, if it's an ex-work sale or ex-factory sale, the responsibility of the seller exhausts at the factory gate. Then it is the recipient who is causing the movement of goods, he is liable to generate the e-way bill. On the other hand, if the movement, if the transaction arrangement is say FOB, CIF or DDQ, any other commercial terms, then it's the seller who has to generate e-way bill and send it along with the goods. So what is this consignment value? The consignment value, to answer your question, is the value of goods as per section 15 plus GST, whatever it may be, CGST and SGST or IGST. But if the invoice includes any exempt supply value in that, you have to exclude it to determine whether it crosses 50,000 or not, and whether I am required to generate an e-way bill. So one catch here, how do you determine what is the value in case of a transportation of goods? Suppose you are giving it on hire, a generator, you are giving it on hire. The value is 5 lakhs, but the rent is say 30,000 per month. When you are transporting it, are we required to generate an e-way bill or not? So the answer is yes, you are required to generate an e-way bill, because the requirement is qua movement and not qua supply. So when you are transporting these goods for delivery to your customer for the purpose of hiring or leasing, you have to generate an e-way bill, mention the e-way bill value as 5 lakh and carry include a delivery challan along with it. And one more thing is the e-way bill portal does not allow you to generate an e-way bill by mentioning the SAC. It only accepts HSN codes. Okay, so from this also we can see that the value is the value of the goods and not the actual consideration whatever you are receiving in the form of rentals. So above 50,000 you have to generate e-way bill. There are two exceptions to this. Irrespective of the value, be it 1,000 or 49,999, in two specific cases you are mandatorily required to generate an e-way bill. If you are sending the goods to a job worker outside the state, interstate basis, irrespective of the value, e-way bill has to be generated. Number two, if you are a person who is exempted from obtaining registration under 24(1) or 24(2), and you are causing movement of handicraft goods on interstate basis, this may not be applicable generally to everyone, but this is what the provision says. If you are supplying handicraft goods on interstate basis, then e-way bill is mandatory irrespective of the value. So what is the information you have to furnish in the e-way bill? Basically the e-way bill has two parts, part A and part B. Part A is general information, which has this has to be filed on the e-way bill portal before commencement. You cannot do it after that. It requires the details of the goods, the origin, the destination, the name of the parties who are involved in this transaction. Part B is the details of conveyance, like vehicle number, what is the consignment note which the transporter has given it to you. So this is generally generated by the transporter. Part A, the registered person fills it and he just endorses it to transporter to fill the Part B, because they will not know which vehicle this person will be using to transport our goods. However, if in large companies it so happens that they have their own conveyance or they take hired conveyance for transportation, in such cases, Part B will also be filled by those companies only. So this is more about who has to generate, how and when. And there are various scenarios which are covered. The law gives some option to some people. If you want, you can generate it. So registered person, even if the value of the goods is less than 50,000, he can proactively generate e-way bill at the option of the registered person. And there is also an option available to unregistered person, because if you see the e-way bill portal, you can only register by mentioning your GST number, otherwise you cannot register under this, with the e-way bill portal. But there is an enabling provision, 138(5), I guess, which provides this, that unregistered person can also apply for enrollment in ENR 3 and generate the e-way bills. But this ENR 3 form, though it has been introduced by way of amendment to the rules in June 2024, it has still not been made effective. So practically, as on date, unregistered person cannot generate e-way bill. So what happens if the conveyance is carrying, the vehicle is carrying multiple consignments, say 10 consignments. The consignments are of mobile phones, 30,000 each. So individual consignment, value not exceeding 50,000. But when you put all 10 consignments together, the value is 3 lakhs above 50,000. So are we required to generate e-way bill in this scenario? So again, here the answer is no, because the requirement comes for generation of e-way bill for each consignment and not conveyance. But some elements are there who just want to split the invoice to escape the applicability of e-way bill, but that can be identified by department if you are following the series of invoice numbers, same customer, same address, everything, but different invoices. So you have to be careful there. So another important point to notice that in the e-way bill has two parts, part A and part B. If you do not generate part B, the e-way bill itself is deemed invalid. There are many decisions on this aspect under various permutation combination. E-way bill not updated, e-way bill not, sorry, part B not updated, part B not carried with the conveyance. We will see them later in our discussion. The exception to this rule is that the goods can be moved without generating part B of e-way bill if you are moving it from your place of business to the transporter's place of business, or if the transporter is moving it from his place of business to the consignee's place of business when you are sending the goods. And if the distance in each of the cases less than 50 kilometers, part B is not required. And another case is transportation of gold. We will see that in 138F. In these scenarios, part B is not required. Another interesting aspect is we see this where the goods are being transported to remote locations which are not accessible by road. There may be multimodal transports. You will take it in a vehicle up to some point and then you will transfer it to maybe a boat or a ship to travel for the other point, or maybe airways. So when you are transloading goods or using multiple consignments for single consignment of transport of consignment, then before each transfer, before the goods are moving from one consignment to other consignment, the part B has to be mandatorily updated. If you miss it, then again you should be ready for interception, and the following consequences of penalty, detention will follow. So there is one rule 7, very minute, not very important. I'll just make a mention of it. The transporter or e-commerce operator or a courier, if he is carrying goods on interstate basis and the consignor or consignee is not generated e-way bill because none of the consignments are crossing 50%, he can himself generate and consolidate e-way bill in EWB2. This is just an enabling provision. This too has not been notified till date. So just for information. Validity of e-way bills. So initially when it was introduced, it said for each 100 kilometers of distance you are covering between origin and destination, the e-way bill was valid for 1 day. Then it was upward revised to say for every 200 kilometers the validity is 1 day. In 1st of January 2021. This is 200 kilometers 1 day is for normal cargo. But if it's so that the cargo is over-dimensional, like you may see it usually say that the windmills, wings, yeah. This is over-dimensional cargo which is above the specified limit as per the Motor Vehicles Act. For these particular types of transportation, the validity of e-way bill is 1 day for every 20 kilometers. And even if your transport route involves multimodal way of transport, like what I mentioned earlier, for some distance you put it in a vehicle or a lorry, thereafter you transfer it to a ship. So if at least one mode includes transport by ship, then also you can take the benefit of 20 kilometers for 1 day. So distance is auto-calculated by the portal. You cannot enter it. You have to just enter the PIN code of the origin and destination. Based on that, distance is auto-calculated. And validity of e-way bill. The e-way bill is valid for 1 day for each 200 kilometers distance. So validity is calculated till midnight of the next day. So now say we generate this e-way bill at 8 o'clock today. The validity is not until 7:59 PM tomorrow. It is until 11:59 PM tomorrow. Until midnight of the next day. This validity can be extended by the transporter in exceptional situations. This is very important. Number of cases have been gone until High Court where the vehicle is just few kilometers or few hours away from the destination. The officer catches it saying your e-way bill is past expiry. So it's very important that we track and update e-way bills, extend the validity of e-way bills wherever required. And moreover, the reason is also we have to give it a valid reason. The generally accepted reasons are accident, breakdowns, or there was a law and order issue, natural calamity. So very important to track and extend the validity of e-way bill to avoid the long procedures of detention. The last point is, once you generate an e-way bill, you can only cancel it on your own within 24 hours. You cannot cancel it after that. But however, you generate e-way bill, you give it to your transporter, he takes the e-way bill and starts the travel. The officer verifies it. In that case, you cannot cancel it even if it's within 24 hours. So details of whatever e-way bills you generate by mentioning the reason for transportation of outward supply, all this will be auto-populated to GSTR1 because it will be tagged to your GSTIN. Any changes, downward revision you make, automatic notice, like how we have been for ITC, DRC01C, automatic notice will come to you stating this has been sold by you or supplied by you, but you have not included it in your GSTR1. So the last portion of 138 is there are exemptions provided to certain types of transportation and certain types of goods also. So if your transportation either falls under any of these two categories, you are not required to generate an e-way bill. I will not go through the entire list. The major ones under type of transportation is if you are transporting goods to a weighbridge. So this happens in heavy goods industry where the value of the consignment is determined upon how much it weighs. So if you are transporting the goods from the place of business to the weighbridge and back, if the distance is within 20 kilometers, no need to generate e-way bill. Second is if your transportation is of a supply which is not treated as a supply as per Schedule 3 of the GST law, no supply. In those cases, e-way bill is generated to be required. What I can foresee, I can think of in Schedule 3 is only bond-to-bond transfer before it clears for home consumption. Under type of goods, the major ones to note are, first one, goods exempted from levy of GST, notification 2 of 17, rate notification. So whichever goods are exempted from levy of GST, if you are transporting that, no requirement to carry an e-way bill. Second is goods which are excluded from levy of GST as per section 9. Alcoholic liquor for human consumption, petroleum crude, petrol, diesel, aviation turbine fuel and natural gas. And precious metals. We will come back to precious metals in 138F, why this is important. So we saw e-way bill is required to be carried along with conveyance as per 68 with 130, section 68 with rule 138. What other documents have to be carried along with the conveyance? 138A prescribes that a copy of tax invoice or a bill of supply or a delivery challan shall be carried along with the goods. So if you are generating e-invoice or if e-invoice applicable to you and you are generating it, 48.4, you can carry the electronic copy of it, no requirement to carry physical copy. Then e-way bill has to be carried. This can be in the form of electronic or physical, and even the circular says an SMS of acknowledgement that e-way bill has been generated is also sufficient. So in case of import transactions, the document number which has to be referred in the e-way bill is the bill of entry number, and bill of entry has to be carried with the e-way bill. There are various judgments also where officers have simply held back the goods stating you should mention commercial invoice number and not the bill of entry number, and vice versa also. So this clarification has been given wherever there is import transactions involved, the document number for reference should be bill of entry number itself. You can also carry the commercial invoice just for reference. So all these are done. Now who can verify it? 138B provides that the proper officer who is authorized by either commissioner or any person who is authorized by commissioner. Commissioner can in fact provide the authorization for intercepting and verification of conveyances, or he can delegate this to any other person, say joint commissioner, additional commissioner, say you give this authorization to any proper officer. Only those officers are empowered to intercept any conveyance at any place to verify the e-way bill for all interstate and intrastate movement of goods. But there is an exception that if the officer, any officer, need not be authorized officer or proper officer, if he has any information regarding tax evasion, then he himself can go and intercept and verify the goods or the conveyance which carrying the goods, but that also has to be with a prior approval. Before we go to 129, we have 4 small rules, 138C to 138F. We'll quickly run through it. 138C provides that if a physical verification of a conveyance along with the goods has been done in a state, union territory or any other state, union territory, it can't be intercepted again before it reaches its destination, right? But again, this exception is if after they verify, if they gather new information stating you are trying to evade tax, then they can again intercept and verify the goods. 138D is a very minute one. It just adds an additional additional compliance burden on the transporter, stating if the goods are detained and intercepted and detained and it's held for more than 30 minutes, because the whole background at the time of implementation of GST said that checkposts are removed, you can seamlessly just carry your goods across state lines, state boundaries. So it says if the goods, the conveyance have been intercepted and detained for more than 30 minutes, then a transporter has to provide this information on the GST portal by EWB 04. 138E, this came later. The e-way bill provisions were there, made effective in 18. Then in November 19, government imposed one more condition stating that if you are a registered person who has not filed their returns, if you are a corporation taxpayer CMP8, or if you are a regular taxpayer GST1, GST3 for a consecutive period of more than 2 months, the option for you to generate e-way bill will be blocked. Or also if your registration is suspended, then you cannot generate e-way bill with the option of outward movement of goods. But however, there is a redressal mechanism where you can apply to the commissioner to unblock it in the form EWB 05. Commissioner will then pass an order in EWB 06 by either approving or rejecting it. 138F. So we saw under the 138.14 that there are certain goods which are exempted from carrying e-way bills. One of the items there was precious metals like gold, bullion, diamond, everything. But however, 138F has been introduced in August 23, which requires that even in case of transportation of gold or precious metals, if the value exceeds 2 lakh rupees and it's an intrastate movement of goods, you are required to generate e-way bill. But only part A. Part B is not mandatory. Maybe the government after implementation, after giving this exemption, they saw some kind of evasion there, so they just want to track it by this.
So I think to just add there, so
yeah.
that is implemented only 4 days back in the e-way bill portal.
They have got it now.
Yeah,
okay.
That is made live on 20th of January only. And Kerala is the first state which implemented this e-way bill for gold.
Which state?
Kerala is the
okay.
first state. Like well, that, as you said rightly, that is there from August 23. But the technical, technological requirements are not made.
Yes. Like ENR 03 for unregistered person, same thing happened here also. Yeah.
Sir, what is the logic, sir? Only for gold they give like that, precious, because what would be the
Maybe they detected evasion there.
No, see, in other case, if the value of the goods is more than 50,000, they are asking me to generate e-way bill. Why they give such special?
There, the quantum is like, but 10 grams is like 60 or 70,000.
10 grams is a very small thing. How will you even detect it?
So, some precious things you are carrying and the information if it is leaked, then
Maybe Kerala because we had that sensational case of that's why they have brought it there. Okay, now moving on to 129. This is the section under which the orders for detention, seizure and penalty are passed. And of the major decisions which have come under e-way bill provisions, close to 750 cases are under 129 only. This section starts with a non-obstante clause stating that it will override any provisions that are in conflict with it under the GST law. So this provision provides that if a person transports any goods or stores any goods while they are in transit, like in a warehouse of a transporter for whatever reason, and such transport or storage is in violation of the provisions of the Act or rules made thereunder, then such goods, the documentation in relation to such goods, the vehicle and the documents of the vehicle can be detained or seized. So this provision is applicable from the moment the goods leave the container's premises till it reaches the destination in the container's premises. Any time in between, you store it, you move it, you just keep it, doesn't matter. This provision is applicable. But before or after that, they cannot go under 129. They will have to go under 65, 67, 70, 74. So the goods are intercepted. The officer verifies the document called for. The driver produces it. And after that, if the officer forms the opinion that the goods have to be detained, then this provision provides that the goods can be released only under 3 scenarios. One, if the owner of the goods comes forward, admits, okay, this is my goods, I admit or I undertake to face whatever the consequences will follow because of this action, then he must pay the penalty. Or if the owner does not come forward, he just does not come forward basically, but penalty is paid. Maybe the transporter can pay it or any other person who is interested in it, or the owner furnishes a security. Only in these 3 instances the goods will be allowed to move further once it is detained. Who is the owner of goods? How will you determine who is the owner of goods? It can be consignor, it can be consignee, depending on the commercial terms. Circular 76 provides that if the goods or the conveyance it carries an invoice or any deliverance or other document, the consignor or the consignee will be determined as the owner of the goods. But if the conveyance does not have any document to state who is the owner, then the proper officer has been given the powers to determine the owner. I don't know how will they do it, but they are given the power. So in case the owner comes forward to pay the penalty, the applicable penalty is 200% of the tax payable. There is no alternative to it. 200% of tax payable in case of taxable goods. However, if the goods are exempted from levy of GST, then the penalty is 2% of the value of goods or 25,000, whichever is less. One very interesting thing here is, previously we saw if the goods are exempted from levy of GST as per rate notification 2 of 17, e-way bill is not required to be carried at all. But now here they are saying if the goods which are being detained are exempted goods, I will levy a penalty of 2% of the value. The catch here is, though e-way bill is not required to be carried, 138A provides the list of documents to be carried. One among the list is bill of supply or delivery challan. So in case of transport of exempted goods, you still have to carry a bill of supply or delivery challan. If that is not there, then penalty would be levied. If the owner does not come forward to pay penalty, it even increases in case of taxable goods. It can go up to 50% of the value of goods or 200% of tax payable, whichever is higher. And in case of exempt goods, from 2% it directly jumps to 5% or 25,000, whichever is less. So that relaxation is still available to the exempt supplies. So you pay, whenever you generate or you make an invoice, you generate an invoice, report it in GSTR 1, pay tax in GSTR 3B, and 100% of tax is gone there. Any minor lapse, pay 200% here. So all in all, you will be paying 54% if something happens untoward in case of transportation of goods.
And this is in addition to the tax which they normally pay, which is say 10 lakhs is tax, then
20 lakhs extra they will have to pay. So previously, now that 129.2 is not there, and 129.1 also read differently before 2022. So 129.1 said, in case of detention of goods and there is a violation of the provisions, you will have to pay 100% of tax plus 100% as penalty. Then the questions were raised on the constitutional law of it. Double taxation for the same transaction, you are asking me to pay once in GST 1 and 3B and once here. So then they changed it to say, okay, we will remove 100% of tax, so we will make it 200% of tax as penalty itself. So instead of taking a direct route, they took an indirect route, but it is recovering the same from you. So the third option is the owner also has an option to furnish security. Instead of paying it by cash, he has an option to furnish security and get the goods moving. Earlier, the 129.2, it provided reference to seizure and penalty under what is provided under 67.2 and 67.6 investigation provisions. But after the amendment in 2022, the seizure provisions and the confiscation provisions have been brought in under 129 itself, so that reference has been removed. So 129.2 is completely omitted. Then 129.3, it says once you detain the goods, the notice has to be issued within 7 days from detention of the penalty. It should specify that penalty payable. So the proper officer for this is again your jurisdictional assistant or deputy commissioner. We have to make sure that the same person is issuing it. It so happens in many of the cases, even though assessee is wrong, he has done some mistake, he is not carrying documents, he is misupdating it, whatever reasons may be, the case is still decided in the favor of the assessee because department has committed a mistake. They have not followed the timelines, they have not issued the required document within specific time. So while drafting any defense in cases like this, it's important to see if the procedural aspects as prescribed under 129 and Circular 41, which we will see next, are followed or not. So after issuing the notice, within 7 days, an order has to be passed. Within this 7 days, he also has to give you an opportunity of being heard. Principle of natural justice can't be compromised, they have to be followed. He has to give you an opportunity of being heard and then pass an order within 7 days. This has to be a speaking order. They say speaking order, but that is, in the experience what we have seen is, they just copy paste the show cause notice and say this has to be paid. And there is no provision for any extension in this. So 7 days, 14 days is the max they can detain the goods within which the order has to be passed. So after this, if you pay penalty, proceedings are concluded. If penalty is not paid within 15 days, they have given powers to the officers to go ahead, dispose of the goods to recover the penalty amount. But there are specific procedures they have to follow. They have to issue an auction notice in DRC 10 and then they have to call for bids. All these things are there. The entire procedure is given under Rule 144. But they have the powers. Within 15 days you have to pay, but this still comes down if the goods are perishable in nature or depreciates in value. Okay, which have very less shelf life. They can bring it down from 15 days to say 1 week, 2-3 days. That's at the discretion of the officer. So the last point here is, in case of detention or seizure, the intent is to recover penalty on the goods, right? But the vehicle carrying the goods is also detained. So one relaxation what they have given here is, if the transporter comes ahead and to at least take his vehicles out, and he pays a penalty of at least 1 lakh rupees, he can take the vehicle and go, but the goods will still be detained with the officer. So there is, if you see 130 for confiscation, there is also a general provision which says, in case of contravention of provisions, the goods can be confiscated. However, because 129 itself is amended to bring in that 130 powers, this is not generally applied by the department, but that does not stop them from doing it. They can still put a penalty under 129 and also allege 130 plus 122 to extract as much as penalty from you. But it is legal or not is a discussion for another day. So this 129, whatever the procedure we discussed, this circular prescribes the same, but in the form of assigning specific forms for each of the actions. So when a vehicle is intercepted and a driver fails to produce any prescribed document, or if the officer intends to proceed with inspection, he will issue MOV 01. In addition, he will also issue an order for physical verification and inspection of conveyance in MOV 02, specifying what is the reason, why is he conducting the inspection of the conveyance. He should have a valid reason. The courts have struck down the entire proceedings because no proper reason was assigned. Just for the whims and fancies of the officer, they want to detain and conduct this inspection. So this document is very important. This cannot be, this is generally not given to the taxpayers over the detention proceedings happening hand to hand, but this can be challenged when the proceedings reach a level of high court. So MOV 2, it will mention the reason for inspection or detention. It will also say where the goods have to be, where the conveyance has to be stationed for the officer to come and do the inspection. He has 24 hours time from giving the MOV 3 to come and complete the inspection. Then he has to complete the inspection procedure within 3 days. He should start it within 24 hours, complete within 3 days. If he is not able to complete within 3 days, he has to get a permission from Commissioner, again MOV 303 for giving the permission to the for extension. Then the report comes in. If the report is clear, very rarely this happens. They inspect your conveyance, detain your conveyance, inspect the goods, inspect the documents, everything. Very rarely they find it in order. In the rest of the rare cases, if they find it in order, they will say, okay, go, they will issue MOV 05, release order. If not, then detention. MOV 06.
But first, everything will be decided when MOV 1 is issued. Practically, they predetermine.
The intent is basically that to just, I mean, for the end of the case, I am saying, I am not saying that the mentality is that, but from the trend of the cases, what we have seen till date, they are more innovative than film directors. They come up with any reason for you to just hold the goods, make you pay penalty.
Sir, in my case, sir, shipping goods location, they told that it is not registered, so you pay tax.
I am also fighting the same case in Chennai.
He has a collection target.
Yeah, so then MOV 06 followed by notice. What we saw there as notice to be issued specifying the penalty, the form is MOV 07. All this will be given to the registered person or the driver. Then the registered person can file the reply with objections against the penalty proposed. He is bound to consider this objections filed and then issue a final order in MOV 09. This has to be passed within 7 days, 7 plus 7 what we saw there. Then upon payment of penalty, depending on whether owner comes forward, not comes forward, 250, all those things, MOV 5 is passed to release the goods and allow it to go ahead. If the penalty is not paid and the person wants to fight it, he can still furnish a bond along with the bank guarantee as a security and take the goods.
Sir, what will be the rank of the officer who has such authority to search, seize or?
He is a AC or DC.
So do you have any, you can ask the authority person?
You can definitely ask. You can definitely ask for the identity card because CBIC has itself acknowledged that in many cases there are fake persons who are carrying out, setting up checkposts and carrying out their own inspection, search and seizure. So you can definitely ask for that. But they will not give you a copy. You can't have.
Below the rank of the AC or DC?
Yes. They cannot further delegate it. The commissioner or the ADC, they are only delegating it. They cannot further delegate it. But they will have a team. The person signing will be AC or DC. So whatever order they pass in MOB 09, this is appealable as per provision to 1076. You have to pay 25% of the penalty as pre-deposit and then you can go for an appeal. Best course of action is 25% of the disputed amount you pay in cash because it can be treated as pre-deposit. Balance 75% you furnish a security and go for an appeal so that you will save on the cash flow.
If that amount is under protest.
It's a pre-deposit, anyways you'll get it as refund if you win the case.
No, we have to pay 100% or bank guarantee. Not
You can. Technically it's being accepted where both you can do a combination of both.
Some portion bank guarantee, some portion
Yes.
cash. Okay.
The ultimate intent is whatever they are alleging has to come to them. But one advantage is if you furnish a security, then the provision itself says that the proceedings have to be fast tracked
On them, so
on the officer.
So even if we go to say it lands in High Court also, so they will also be they also have
No, fast track up to their this thing only for passing the order.
Passing the order.
Yeah. So instead of 14 days, they'll say take 7 days.
The bond is for the amount 200% and all those.
Yes. So 200%, 25% of it, 50% you pay in cash, 150% you can go for security. Yeah, please.
If the vehicle is not detained in say let's say Karnataka, the supplier is not registered in Karnataka, then the facility of this 25% and the guarantee of 75% is available.
Yeah, you can.
On the basis of the temporary registration, what?
You can obviously demand for it, you are right, but officer will allow or not is a different story. But you can definitely do that.
Again, if they don't accept also, if you want to take a High Court route, they can file here. It's an interstate transaction coming here. The officer is not listening for whatever reason.
So they will assign a temporary registration to you, log in and pay through DST.
So if they are not accepting that proposal of 25%
Yes.
and balance, then ultimate option is to knock High Court. Here we can.
Not everyone can go for High Court. Say, suppose if the tax involved is only 50,000. Okay, 200% off is 1 lakh. If you go to any advocate, the fees will be more than that. So, not feasible also. So, the best course of action you have to just determine there. Then there is MOV 10 and 11. MOV 10 is confiscation. If penalty is not paid within 14 days, because now the powers have been given for the officers itself to dispose of the goods, MOV 10 and MOV 11 are very rarely used. And MOV 9 and MOV 11, the orders, either for confiscation or levy of penalty, they have to be uploaded on the online portal electronically in DRC 07, against which you can file an appeal. Okay, so this circular brings a lot of relief to the persons transporting the goods, because if you see, e-way bill implemented April 18, first circular April 18, second circular immediately has come in September 18, because in that 6 months itself, the number of cases which the officers initiated was so huge, and the issue, if you see, is all minute. And all those minute issues have been covered here. In case of spelling mistakes in the name, private limited, PVT limited. So, in case of spelling mistake in the name, but if the GSTN is correct, penalty at 129 rates cannot be levied, at 200% or 50%, all those things. Nominal penalty, just to like a tap on your knuckle, they'll say pay 1,000 rupees and take your goods. They should actually, they will come secondary, but they should do that. Mistake in PIN code, because the address, so the distance is determined based on the PIN code. If any mistake in PIN code, that is also acceptable as long as it does not increase the validity of the e-way bill. Error in address. So if the locality is same, then error in address is also acceptable. Other details, locality and other details should also be correct. So door number 520, you mentioned 250, but building number, area is same. They should just levy penalty of 1,000 rupees and let you go. Document number, you mentioned 1004 instead of 10040, they should let you go by 1,000 rupees. There is an HSN code, 4 digit or 6 digit. If the first 2 digits are okay, tax rate is okay, they should let you go. one or two digits mistake in the vehicle number is also acceptable. So whenever the conveyance is stopped and the allegation is one of these, you can, when you are very much in your rights to force and demand the officer to not go with the entire battalion of 129, just take this 1000 rupees penalty and leave us. So we have 15 minutes and I have few case studies. I couldn't put the animation to see to what the answer is, but just bear with me. In this first case, goods were being transported from Bangalore to Chennai with valid invoice or specified documents and e-way bill. However, the conveyance took a different route. What Google Maps shows one route, he took another route. The officer detained the goods and he said penalty is leviable because you are trying to do something unscrupulous. Is it valid? 129, as we just saw, it says if the documents are not being carried upon verification, if it's found violation of provision, then only they can go. Nowhere in the provision have they said that the particular vehicle has to follow a specific route from A to B. Right, so this is again innovation of the officer. Nowhere in the law it has come down. This proceedings can be challenged and we are bound to win it. We have a couple of decisions from Allahabad High Court. One in case of Vishal Steel Supplier and one in case of Exide Industries. This is also supported. The second case is a conveyance was carrying goods from Bangalore to Hyderabad with valid invoice, other specified documents and e-way bill. Okay, the e-way bill was generated on 1st of January. Distance is valid till 4th of January. On 4th January at 11 p.m., the conveyance met with a minor accident. Right? And needed repairs. The e-way bill could not be extended within 8 hours. That is, so 4th of January, you have time till 5th January 8 a.m. to extend the validity of e-way bill. That also could not be done. At 6 a.m., before the time limit to extend the e-way bill, before that exhausted, the vehicle was detained by the authorities. The repairs are going on, they come and detain the vehicle and say penalty is payable. In this case, we have a very important judgment by the Supreme Court, rather Telangana High Court, which then was affirmed by the Supreme Court, in case of Satyam Shivam Papers Private Limited. So the provision does not provide that you have to, there has to be a mens rea or intent to evade tax for levying penalty under this particular section. But high courts have repeatedly held that 129 is such a draconian provision, 200% of tax payable, 50% of value of goods, for no reason you cannot levy it. There should be an intent to evade tax, then only you can levy it. Right? So in this Satyam Shivam Papers case, what has happened is the officer challenged the judgment of the Telangana High Court. He went to the Supreme Court. The department itself challenged the decision. Supreme Court got agitated. They levied personal penalty in the officer of 69,000, stating you are coming at unscrupulous, needless litigation coming and putting it before me. So they have made a very clear rule stating that intent to evade tax is a must in case of levying of penalty under 129. And if you breach all these guidelines what we have levied, then be ready to pay personal penalty.
Unlike the other provisions where we can go for an appeal based on 10% of payment, here that
is not
that provision is not there. That's itself is a huge.
So that's why the number of decisions which has gone to the High Court directly is because of this. So they don't wait for the order, they just go there, take the relief because they want a cause of action to apply for it. The cause of action itself is this notice. So with this you can go.
Sir, the law itself says 8 hours. So they were caught at 5 a.m. So by the provisions of the Act only the officer should not have.
Yes. So this second one, Daya Shankar Singh, 4.5 hours, they have caught the vehicle. The law is told no, they have still time, they still have the right to extend it. You cannot detain and put this penalty or detain the goods. They are clear on that.
But the officer level only, this should not have been.
This should not have happened, this has happened.
But it has gone to, the first case has gone to Supreme Court.
Yes, no, that is different. That there was a, what do you say, law and order issue. Okay, during the transportation there was a law and order issue. The goods during the transit it was kept at a relative's house for 16 days. Okay, but the documents were in order, only e-way bill could not be extended, that's all. Everything was in order. There is no other discrepancies which the department has raised. And the petitioner was also very mindful in that, and they have gone and put all the arguments. The Supreme Court accepted it. Sorry, Telangana High Court first accepted
but
it.
the provision was violated in the first.
Yeah,
Like 8 hours.
that was violated, but again,
But again, mens rea.
Mens rea, correct. Yeah, so this third case is again one more new, the officer is trying to club two provisions here. The goods were intercepted, they were detained. The allegation was goods are undervalued. The goods MRP is 100 rupees, you are shipping it at 70 rupees. Okay, again the Chhattisgarh High Court in the case of KP Sugandh and Kerala High Court in case of Alpha Group, both have held that. This has come in 2020, the initial stages of this implementation itself. Stating, why are you going into valuation? That is not your forte under 129. If you want to do 129, do 129. Don't go under 73 and 74 for this. So, if that is the allegation of the officer, you can fight it.
Sir, classification also they will not do, sir. They should not do, sir.
Yeah, there is one more case. I will come to that next. Coca-Cola case. So, fourth one, a conveyance was carrying goods from Bangalore to Mumbai with valid invoice, other specified documents. The conveyance was intercepted, and after verification of documents and goods, was detained on the ground that he did not carry original invoice. Right, 138A we saw invoice has to be carried mandatorily in case of taxable supplies, bill of supply, supplies. Here the allegation is invoice is there, but it's not an original invoice. It went up to High Court, Karnataka High Court itself. It's Kolvekar Logistics which said, you read Rule 48. What does it say? Original for the customer, duplicate for the transporter, and triplicate for you. When the rule itself says the transporter has to carry duplicate invoice, how can you ask for original invoice? So again, it has come out down heavily on the officers, but no personal penalty, thankfully. So these case studies are just put to see, give an overview of what kind of issues the officers can come up. And that makes it more important for us to have everything in order so that we don't give any room for this. This is part B of e-way bill, number 5. The goods were intercepted. Part B of e-way bill was incomplete. It was still carrying. So we saw under 138 that part B, if it is not there, it is invalid. Here part B was carried, but it is incomplete because vehicle number was not mentioned. There also there is a relief stating that since there was no mens rea, no intent to evade tax, the penalty under 129 should not be levied. So the whole summary is, as you can fight any minor deviations as long as you can prove that there is no mens rea. This is what we'll have to just see if the client wants to take the cases to the higher forum. So this is at least a lower thing where part B is incomplete. We also have a favorable case where part B itself was not carried. Allahabad High Court ruled in favor of the assessee, stating even if part B is not carried, if you are not able to prove any intent to evade tax, you cannot levy any penalty under 129. Because many of these judgments are referred to 126, which said you cannot simply go under the specific provisions and levy the higher rate of penalties when the infraction itself is minor. So 126 defense is something which we can explore in all cases, not only under 129. Then we have this Coca-Cola case. So here, Coca-Cola is, we all know, irritated drinks, liable to tax at 28%. The officer intercepted the conveyance, verified the documents. He saw that the invoice as well as the e-way bill have the rate of tax as 12%. So he said you are trying to evade tax, and he detained the goods, put a notice and also an order for 28%. Sorry, 200% of the tax payable. Again here, like the valuation, the High Court came down heavily on the officer, stating verifying the rate of tax applicable and validating the same is not within scope of 129. Please restrict yourself to 129. And hence the detention was also had to be invalid, along with penalty was also quashed. This is also procedural thing. Like what I said, procedure infractions for a department can also come to your defense. Goods detained, intercepted, detained, and order also notice issued within 7 days, but order was not passed within 7 days. High Court, Madras High Court has said, since you are not followed the procedure, you cannot expect the assessing to follow the procedure. Release the goods and refund the penalty whatever was paid. So last one under favorable case laws is purchaser rendered e-way bill shared with the supplier. Supplier based on the e-way bill initiated the transport, but without mentioning to the supplier, the purchaser has cancelled the e-way bill. Conveyance and goods detained, e-way bill verified, found to be invalid, penalty notice given and order issued. Again, intent to evade tax came to the rescue of the assessee here, stating that since there is that is not available or present, you cannot levy the penalty. Similarly, there are very few judgments under e-way bill which are against the assessee. I have just tried to pick what may be relevant for this discussion. Out of the 750, if you see, 80 to 85% is all favorable only, because they always hold intent to evade tax and other criteria to bring it in favor of the assessee. So the conveyance carrying the goods in transit suffered breakdown and was intercepted. It was detained. It was found by the proper officer that e-way bill had expired. The proper officer proceeded to levy penalty under 129. The district person argued goods are interstate supply and hence penalty cannot be levied in the state. So he is saying I am transporting it from state A to state B. In state A, the particular breakdown has happened. He said you cannot instigate any proceedings against me in state A. Whatever is there, you have to go and initiate state B itself. The High Court, in this case Calcutta High Court, it said the penalty is also rightly levied, first on the merits, and then on the technicality it also it says, since the goods are found in my state, I will levy penalty in my state only. The argument that no intent to evade tax was rejected. This is deviating from that the Satyam Shivam Papers Limited stating intent to evade tax is very important. So we saw a case where Part B was e-way bill was not entered and they allowed the goods to go without levying penalty. Here we have a unfavorable judgment against the taxpayer. The department will use this, we will use that. Again, it has to be decided by the Supreme Court itself. Here the High Court, Punjab and Haryana High Court said it is not within the powers of the officer to see whether intent to evade tax is there or not. Any violation 129 can be rightly invoked by them, pay penalty, take the goods. The last one under this, interesting one, but this is under customs, I have just brought it to provide the context. The police officers had an information that a conveyance carrying smuggled goods were being transported, right? And they intercepted the goods, seized it. In case of Sangha Enterprises, the state of Assam, when the assessee went to the High Court held the police officers are well within their powers to intercept and seize goods if they are in violation of any law. But they have to hand it over to the concerned department after their proceedings are concluded. They cannot do away with it, they cannot confiscate or sell it off. Interestingly, we have a favorable decision in Allahabad High Court under GST itself, which says that in case of Vishal Gupta, that police have no authority to check invoice, e-way bill and take account of goods. So we have both the faces of a coin. All these have to be finally decided at the Supreme Court level, but till such time you can use all these defenses and even more defenses to defend your case. So this is all from my end. I think I have finished it within time. Thank you. Yeah, please take.
So the circular 64/2018,
at point 5, it reads as they have mentioned various scenarios with the minor mistakes points.
Yeah.
So there's a word called inter alia.
Inter alia.
Yeah. Do you think that opens a Pandora's box and many other possibilities can be incorporated into that? Because the inter alia word means not restricted to.
Correct. They can do that.
So there could be scenarios where it is a minor misstatement. It is not covered under point A to F as enlisted there.
Yeah.
So basis that can be filed an appeal.
Yeah, we can file an appeal. So there are cases where many places in India, the maps are in such a way that if you have to pass from location A to location B within the same state, you have to go through another state.
Yeah.
Right. So in that cases also, they are holding the goods and state levying penalty there simply for the reason of it. So you can still fight it. It's very valid.
So you have the opinion that point A to F is just a suggested list. It is not restricted.
Correct.
There can be many more scenarios.
It's anyways, it's binding on the officers. It's not binding on us. We can expand.
Thank you.
Sir, in case of return of goods after expiry period of November for previous year, in that case I am issuing commercial credit note and then taking back the goods.
Others, category others, delivery challan.
Delivery challan, not EVP.
No. EVP bill is required. Value more than material EVP bill is required. I'm saying for a tax purpose, issue a delivery
The goods
challan.
are expired goods, then even then also I have to see that.
Yeah, goods are coming back to you, no? It's movement of goods. It's not taxable supply. It's for supply other than supply.
No, when goods are expired, the value will be less than 50,000, but I am paying to the customer.
You assign the value and then decide. Whatever value you assign finally, based on that you have to
It is
decide.
not required. However, you will not have tax invoice in this case. You will have only delivery challan. He may not be issuing a credit note.
So the goods are transferred. E-invoice was missed out. E-invoice.
E-invoice you have not raised or you are not carrying with the conveyance.
E-invoice was missed out due to some unforeseen situation.
That is you have not raised it.
Not raised. So immediately should go the conveyance. So anyway, 30 days
If
time.
he catches it, just generate the invoice there and give it because e-invoice is always in electronic form. No need to carry physical invoice.
There is 30 days time limit. 30 days time limit is there.
Time limit is there, but you can use it for services. Practically for goods, if you use the 30 days time limit, you will have the order in your hand by that time.
So immediately the officer will ask the penalty.
So you give it to them. So you say, I will present it to you. MOV 1, MOV 2 we will issue. Within MOV 3, for MOV 4 you can give it to him. But again, he will fight on technicality on the timestamp.
Yeah.
Okay, that you can again, you have to go to higher forums and say no intent to event tax.
Immediately we can generate and give it.
Yeah.
They should accept.
You see, ideally they should do so many things, but they are not doing it.
So the customer is getting stuck in a UAB issue. The only saving grace will be a high court because the lower
If you want to
forum
immediately
will not
take
get
it out, yeah.
will not get favorable order.
Sir, customer will come to my premises and he will shift the goods to his customer premises.
Okay.
Okay, in this transaction, I need not to generate the EV bill.
You are not causing transportation of goods, no?
So he will generate the EV bill from my location to the other location.
Yes. So there is an option of dispatch from also. Ship from, ship to. You can mention that. But again, there are cases stating this is not in your registration certificate. That is additional place of business. They will again fighting it. So.
Can't we have that kind of when the officer details we can't ask the intent of stopping? Can we?
Yeah, they will give you, no? If MOV 02, if you see, they will have to mention the reason.
On the road itself, when it details, can we ask that what is the motive of you stopping it?
They have the powers to intercept any conveyance at any place. There should be, they did not assign reason for interception. Only for detention they have to give reasons. That's why, because of paucity of time, I didn't cover one thing. There is one more thing called RFID, Radio Frequency Identification Device. So the commissioner has power to notify this specific class of transporters to install this in their vehicles. That advantage of that is you need not stop anywhere. Okay, the readers or the readers will be installed in specific places, generally in toll booths. So whenever you are passing a toll booth, the device will identify, okay, this conveyance mapped to this CA bill is transported here. So it will get over there. It is not still widespread, adoption is not there, but that is in the line. You know when it will come.
But in that case, no sir, I will give invoice 50,000 and I will transport for something like 5 lakhs or 10 lakhs. There will be misuse of law, no?
That how that RFID will be implemented is also important. Because they are saying specific class of transporters. Not everyone will be given that power to do that.
Maybe some big transporters.
Maybe like how they did this ASP GST licenses, they will do some
Phase wise.
Yeah, and then they will give this license.
Thank you, Nithin, as well as Pradeep, for your exhaustive session. I think it was most relevant topic which needed much more time, is what I understand. But we'll probably have one more sequel kind of a thing, series kind of a thing on this. So on behalf of Bengaluru branch, we thank both of you for taking your time out and sharing the knowledge. I request our chairman to hand over a memento to both the speakers.